Inflation is down to 5% year over year. The producer price index just came in. It declined 0.5% over the last month. What does that mean for multifamily rents, the economy? If you want to know, stick around, because every week at The Gray Report, we're breaking down all the latest research reports, articles, the new data points, and throwing around some original commentary, everything revolving the multifamily industry, commercial real estate, housing, and the economy. So if you're a multifamily investor, active, passive, you're in the industry, you're in the right spot. Let's get into it. Welcome back to The Gray Report. Thank you for joining us once again, joined by producer, co-host, Dr. Matt Bosnakel, Director of Communications and Marketing here at Gray Capital. Matt, interesting week as the macroeconomy, the family. Things are getting a little softer, but also maybe a recession.
Yeah, I don't get it. This has been a weird week. Definitely interesting, and not interesting in a bad way, like interesting times. Yeah. But I don't think the market kind of quite knows what to do with itself.
Well, we were talking just before this, and how the market was responding to the report that the Bureau of Labor Statistics released on their monthly report on inflation and the consumer price index. Yeah. Inflation, while still certainly elevated, it's down to 5% year over year. We're back down from those peaks. High 8%, almost 10% inflation according to BLS. The real number, whatever.
And I'll give a teaser out. Yeah, it might even get lower.
It is, and it could be. Well, maybe it is right now. Yeah. Depending on how you look at housing, a lot of people are actually taking housing out of the view of inflation. They call it, what is it, the Powell? Well, it's like the Powell index. Okay. And it's core services minus housing. Okay. Because housing is the way that it takes up a third of CPI, but it's a complete lagging indicator. It's about 12 months behind. And we know how quickly rents were rising and how they've been declining over the last 6 months. So it's, market rents, I think we're seeing them actually pick up. Getting into the spring leasing season, we're seeing some momentum after 2 quarters of declines. But according to the CPI, it was that it's still rising and it still has to go down. Yeah, representing the last 2 quarters before it then begins to rise again. So it's just it's like the tail wagging the dog. And
it really is. It's like we're towing a large boat, and like a sharp turn here, and then you got to wait for the boat to turn around, and it could easily swing things in a weird way, and it's not always like it's not always perfectly lagging, as we'll kind of get into in a second. But I saw these CPI numbers as kind of an unalloyed good. Like, this is great news. It's not necessarily accompanied by like a downturn in like hiring or anything. At least as we've seen from like the PEC numbers were good from a week or two ago. And so I thought, maybe this is great. But then that same day there was a Fed minutes meeting, and they released some of their projections, and it seemed like a pallor. Like a little bit of a haze. The uncertainty started creeping back into the market, such that at least the stocks weren't like all up yesterday.
Yeah, no, Matt, in one big other piece of news, eggs are down.
Thank goodness.
Eggs are down. See, it's a good sign.
And that's another example too. Is we were talking yesterday. This was before I even saw the CPI numbers released, and I said, I read this recent Wall Street Journal article that said that food prices are the new inflation threat for governments and central banks. But in this new CPI release, food prices are not going up. They're relatively flat month over month. Now, big change year over year, but
and same with eggs.
The trend is not. And that could be, a volatile thing. They're still up 13%.
I mean, 13%, food's up 13% year over year. So you still feel that because, people don't feel those prices. I mean, some right away, but this is up, then this is up, and then it's just, boiling frog situation. But we're feeling that, even though, Matt, to your point, it was flat. All food is basically flat. It's stopped growing. And, we saw some, meaningful declines in, quite a few sectors. Uncooked beef roast, down 2.3%, Matt, just month over month. Wow. So, now is a time maybe to go barbecue and do some.
Very good. I wonder what saw the biggest swing in the food.
You think, maybe you think, we benefited for Easter.
Yeah,
Man.
yeah, that was good.
Hams on sale. Hams on sale. Still up 4.2% year over year. But the Frankfurters also a discount of 2.9%.
We need to have that. Maybe we need to track that every week.
Yeah, the Frankfurt index. But again, eggs month over month,
yeah,
down almost 11%, but up 36% year over year. So we're still feeling the pain on eggs, but we were down a couple bucks, fortunately.
And this does, even in our like silly examples with like ham and eggs.
The BLS reports on.
That's a good point. That's a good point.
To somebody.
But even in that, you see things, they'll go down and they'll go up. There's always seems to be this like ripple effect where there's some element of compensation. And there's going to be several graphs that we'll bring up today where you can see where things are going in general, but there's always room for there's always a little bit room for variation. And that's what's puzzling me about rents is, we've talked about this and I know this is kind of the elephant in the room, but we've talked around rents and how they're a lagging indicator. And even the Fed earlier this year, they released their own versions of what they think how rents should be maybe more accurately measured. But the fact is, on the whole, CPI rents are 1 year behind, if all things considered. Now there are certain things that can make that different, but we are arguably, and this is a headline from a recent Apartment List article that was written the same day that the CPI numbers came back. It's like, man, they got to it quick. Oh, yeah. They said they're ready, probably at peak CPI rent. Rent of primary residence is at 8.8 right now, and it went up 0.5% month over month. Now, last month it went up 0.8%, and the month before that was 0.7%. And I looked in previous months, and it was all similar, 0.7, 0.8. It's to have the month over month change in rent of primary residence go down by 0.3%. It seems like a little, but it's a lot when you're talking about something that moves so slowly as like CPI rents. And again, like it's like a rolling hill rather than a spike. And the argument is, and it's a really strong argument, is we're going down now.
Yeah, I mean, to me, it looks like a deceleration. Again, we're looking at a year ago. And why are we even, Matt, we know what's going to happen. I mean, we've already lived through, again, like.
Do you want to bring up,
while we are corporeal beings,
very true.
Look at this from a nonlinear perspective, looking at the timeline. I mean, we know what the last 6 months were like. Rent declines across the nation, certainly rent slowdowns. There are only a couple markets in the nation that have positive year-over-year rent growth. Yeah, Indianapolis, Miami. But we know it's going to happen in CPI, so we know that inflation is going to come down. Now we have to, so that's why it's almost like take shelter out. We know what's going to happen. Like we know that story. Maybe we don't know the rest of this year, and that's what we're going to cover. From the back half of the episode of what's going on with rents today. Yeah, but it's watching the crash in slow motion. We know that inflation is going to come down. We know that things are slowing down, and that's why there's a fear of a recession. Yeah, but there's still, I think it's premature, Matt, and I'm curious if you're
to say that inflation's over.
That that inflation's over. Yeah, and two, that like we are certainly going to have a recession. In Q4. I think that we are certainly set up for one. But
I think there has been it. We've said this it depends on how you define it. We could maybe have a recession that gets defined into a recession. We could maybe be in a recession right now. We don't know about it. Yeah. I think we're going to be in that hazy area between, is it a contraction or a recession? I don't feel like we have a whole lot of crisis that we're building towards. Now, I've seen there were some other news articles that had come across in this past week where they were comparing, how vulnerable we are compared to 2007, 2008, and like we're in a lot safer position than we were.
We are, but the one crisis that we do see out there, I think that, and it's not a crisis yet, but again, it's the slow motion, high frame rate, camera being played back. of the car sliding.
Yeah, exactly. Yeah. Oh, it's only a little bit worse than it used to be. And then you take a look back and you're like,
I'm think of commercial real estate.
Yeah.
I mean, okay, we're going to talk about how multifamily is looking pretty good right now from a performance standpoint.
Yep.
We know about the valuation story, where interest rates are. It's uncertain. There's pricing uncertainty. There's volatility in pricing. There's not a lot of price discovery. And we can make a good argument for multifamily is going to be relatively unscathed, even though there are going to be some borrowers that are going to be in trouble. But it's so well positioned, multifamily is, compared to other asset classes in commercial real estate, specifically office, and then some other types of real estate that are also bought on, floating rate mortgages that may be coming to expire soon. There's just, the fact is, and again, these may be good assets, like that weren't bought at wrong price. Some people paid way more than they should have. But a lot of these assets, aren't necessarily, they didn't overpay too much relative to cost of construction. But the market is what the market is, and financing is what it is, and the market is what someone's willing to pay. And if you can only pay, a fraction, even though it's below replacement value and below what someone may perceive, certainly the seller, as fair market value. Well, sorry, but that's the only way that the numbers work. It's kind of a math.
And that's what, and we'll get to it later, but there's this Newmark report where you'd think that apartments were doing great because everything looks so great about the performance looks great. And in their assessment, they say, sales demand may be slow in the first half, but it'll be okay in the next half. And I'm just thinking back to this idea of, the performance is against it, but the numbers don't work. And it's the same thing we're seeing in the home buying market. The demand is there. Yeah, we want to buy it, but it's just too expensive. And short of tragedy, short of someone that is facing, they're up against the wall like this. I guess there's a Houston multifamily operator that had to unload a bunch of units. Just this past week, there was, I put that in the newsletter on the last minute.
Sign up. I mean, createcapitalllc.com/newsletter.
That's true. Right. And all these conversations, I keep thinking like, it may not characterize the market. It may be these independent moments where someone's in trouble. You got to scoop that up and gradually.
Yeah, and that's the thing. If it's just these individual moments, these individual deals one at a time, that's not enough to move the market, because there's one deal and, it may float out there, but it's like, that's not like, the entire market's right there. And someone who's like eager to buy, may come up a little bit further because, they want to buy it.
Yeah. And so, just to kind of square the circle here, like the real upshot for people looking at, for multifamily investors kind of looking at the CPI, yes, it's maybe kind of ability to pay rent, but also like, what are the rates going to be? What do you think the Fed is going to do with, and it almost seems like, just kind of considering what we were thinking about, they want to make sure that people are scared enough that this isn't going to all blow over. I think that they want to create the impression in people's minds that this is going to be longer term than you think, that you can't just wait this out. You're going to have to make different decisions now, in order to, it's not a wait and see thing. It's like, I think they want to create that situation where maybe people do sell. Maybe we're like, we can't get out of it.
Yeah,
and that's the kind of damage. And
they do. Yeah, they want to bring it down enough to cool things down, but they don't want to wreck. They really don't want to wreck things too much. I mean, do you believe, Matt, that the Fed believes that they are trying to accomplish a soft landing, smooth landing, where there's ideally no recession, but like inflation's down and all is good? Like, do you think that do you think Jerome Powell sees him? He's like in a cockpit.
No,
and he's on approach. Is he trying to land that? Is he actively trying to land the aircraft, the economy, or is it just?
See, I think that
we have to go hard. I'm going to crash it. We need to crash because
he's coming in. It almost seems like
play chicken. He's playing chicken.
He's playing much more. He's coming a lot faster when it comes. When it comes to like rate hikes. He wants people to be a lot scareder that things aren't going to be great in the next few months.
I know that is what he needs us to believe. But do you think that he believes that he actually can accomplish a soft landing, prepare everyone for a recession, and make everyone believe that there's a recession? Because so if I was trying to accomplish that, I'm not saying that I would or I could.
Yeah.
But wouldn't you would wait until you see the whites of their eyes, right before the bulk of loan maturities begin to come due.
Yeah.
Or a certain time that would be appropriate for, mark-to-market, adjustments to take place for lenders to be accommodative. So right before, rates drop.
Yeah.
Or in some way, or some indication that rates are going to drop. So it's up here and we're past, like, people are like, we never thought he would have held them up here so long. We never thought every month they, maybe the increases stop, but we're plateaued, close to 6%.
Yeah.
They were like, this isn't going to work. We can't refinance these loans at 6%. He's not doing anything. Why would he didn't change last month?
Thought we could wait this out. Yeah. Yeah.
And then literally at the last moment.
Yeah. That is
back on the accelerator.
Yeah. It'd be interesting then to know what the signals are that he's like, all right, now people really got the picture. Now I can.
Yeah, I think they got a little bit of it with the banking crisis, but not enough.
Yeah,
I think they're going to use a commercial real estate. I think that's what they're using.
That's like I think that's a really compelling interpretation, and because worst case scenario, like I think the impression of people is whether or not he thinks he's going to pull back at the last minute. Like they think that he's going to be more hawkish, and he's going to be kind of a little bit more inured to the possibility of crisis than people were thinking before.
Yeah.
But yeah, I hate to. I mean, the ideal case, why wouldn't he want to pull it back?
Right. I mean, yeah, that's why. I mean, the Federal Reserve's main tool is psychology and signaling. Like the interest rates are they are important, obviously, but not nearly as important as the.
And that's what surprised me because, like I said, like the stock market reacted it was like a chilling effect when they read those Fed minutes. And I feel like there's a lot of people that really, really, really want to predict that the rates are going to be lower. And that's going to be a hard thing for them not to be like, no, I trust that he's going to be secretly nice at the end. He has to make everyone believe he's not going to be.
Rates are lower. People can't believe it now. I mean, the 10-year Treasury is much. I mean, we're in below 3.5%. I mean, so we have seen the rates come down. The market is pricing that in.
Yeah.
And the IMF came out earlier this week, I believe, and said that they believe that we're going back at 2019. Interest rate levels like soon. So it's like you hear that and it's like, is the IMF saying that because they need the rates to be down that low because all these developing countries are literally going to not be able to continue without some incredible more intervention. So are we trying to will it into existence? We're trying to will the recession to resistance, and that's again, we get a recession and maybe we have to flush it out of the system. I'd rather have a recession now rather than drag this all out and have uncertainty and volatility. Let's flush it out of the system again. Like it's the controlled burn. We got all this dry timber out here, and let's get rid of all this. Let's burn up all this grass in an ideal environment. While we know what we're doing rather than waiting for the lightning to strike or whatever.
Yeah, and my kind of first conception of it that I was trying to paint is like I think he does want to get in people's minds that this is going to take long enough where you are going to have to make a different decision, and I think that implies maybe a duration of like some of these decisions. There's a year wiggle room where you're like, well, can I wait it out or can I not? When it comes to like or the refinancing or buying or selling commercial real estate. Do you want to hold on to it? Well, if it's a year, maybe not. But if it's 3 months or 6 months, maybe even 9 months, there are some edge cases. But yeah, he's got to strike that fear.
I think there's a lot of information out there. There's a lot of people who say, are so certain about some things, whether interest rates are going to be lower, inflation's going to be higher for longer. I think that we need to remember, though, that there are some big forces out there that we've been on a track for a long time.
Yep. Very true.
Inflation can be higher for a couple of years, and interest rates, along with that, should be higher as well. But I think we need to remind ourselves about technology, the conversations of AI, and this sounds like a tangent, but it's not, man. I mean, it relates to inflationary forces and deflationary forces over the long time where interest rates are going. I mean, even over a period of inflation. I mean, look at the deflation in technology, even in this inflationary period. Smartphones, man. Smartphones year over year are down 23%.
That's incredible.
TVs are about down, I think, 10%. Education and communication commodities are down 10%. Information technology commodities down 11%.
And that's interesting because you're not seeing the exact same stuff for the car and the used car market.
Television's down 14%. Video equipment's down 3.5%. Video and audio products down 5.5%. Used cars and trucks are also now down 11%.
All right, well, okay, 11%. That's actually pretty good.
Yeah.
I take that back.
But we are going to continue to be a more productive and efficient society. That's one of the reasons why we've had lower interest rates. Yeah, it's a lot of artificial, talk about, central banking and, growing governments, not that, but we've created more efficient, financial systems, more efficient market, better at pricing things. We have more information. I mean, here's the way I like to think about it. Think about in real estate context. Yeah. Real estate investing back in, called the 50s, 60s, and 70s, the returns were much higher. The interest rates were, at least in the 70s and 80s, were higher, but not necessarily in the 50s and 60s. Higher than they were in the last 10 years, but not as high in the 60s and 70s. But the returns were way higher. Yeah. Way. I mean, you could get 15% cash on cash, 20% cash on cash, year one. You know why? Because people really didn't have all information. People don't have Excel. People don't have CoStar. People don't have smart pricing information. People are doing it on the back of a napkin, using a slide ruler and using round numbers and getting it pretty close. And that works get pretty close. Yeah, and you can make some money. And you're like, well, we thought we were going to make 40%, we ended up making 50%, or we thought we were going to make 60%, we made 30%. Yeah. It's just wide swaths. There's a lot of variation. Standard deviation is really wide. And so that volatility equals risk. So there's more risks you don't know. Yeah. I don't really know because I don't really know about the market. Okay. And so that becomes higher risk. It leads to higher rates, higher returns, potential returns, also potential higher losses. Yeah. As we have more information, we can get information quicker. It creates a more efficient system. That's why the stock market it's a pricing mechanism because it's so efficient. You have transactions, people making decisions, people's thoughts on the future are recorded in the form of a price, at fractions of a second, throughout the trading day, and something like, risk asset like Bitcoin, 24/7. Yeah. So while real estate, we don't have the transparency that the stock market has, we have a lot more information and ability to analyze and be really critical today than we did 20, 30, 40 years ago. It's like that throughout the economy. And think about now, we can communicate quicker, we can be more productive, we can get more things done. That efficiency creates, in many ways, less risk. Now, we can misprice risk also, because you have a 0% risk-free rate. How do you price in that risk? Yeah. And you discount risk because everything is good. So there can be some mispricing of risk, as well. But we're moving towards we've become more efficient over the last. The trend over the last couple 100 years and 1,000 years is more efficiency and increase of technology, which makes things relatively cheaper. Now,
yeah, well, and it's hard to not see, and Olga, you breathed the word AI, but it's hard not to see that, that's some people are doing the work of 2 people doing the work of 10 people. I don't know where the jobs are going to go. That is a big fear, and it is, there will be it will be sad and bad for people. I'm not going to say, there's going to be some adjustment. No, but it's going to make it cheaper.
Let me ask you this: how many jobs has AI created versus destroyed year to date?
Oh, right now I don't think it's destroyed many jobs.
I know but how many? What's the net?
Oh, I have no idea.
I guarantee you, thousands upon thousands of jobs have been created because of AI, and I don't believe many have been destroyed.
I'm sure that
I think companies have become more productive. I think employees have become more productive.
The productivity gains will the value of the money saved is going to be a lot more than the lost wages of these people. But again, it's going to be an adjustment. It's some pain, but it's going to make things cheaper.
Yeah. People, there's going to be some shakeup, and I'm not saying people won't lose their jobs to AI. I just think that it's going to, in general, create more wealth and prosperity than it will, detract from.
Yeah.
I believe. Again, it's all how things lay out and, who's actually, writing the scripts and whatnot.
Yep.
Matt, just to, again, put a bookend on this macro talk.
Yes.
Really quick. It was Jay Reeder, CIO here at Great Capital, sent us a graph showing some savings rates and credit card debt. And it was a little alarming because basically, let's look at some of the graphs right now. Here we've got the personal savings rate. I mean, back in the 60s, it was 10%. Now, again, you weren't earning some interest in your bank account back then, especially in the 70s. It really spiked here back in 1975. Now, Matt, so 17.3% you get in a savings account in 1975. Is that the case?
No, I think this is the amount of,
amount of people who are saving.
Yeah.
People are saving.
Yeah.
Of course. So, people were saving quite a bit in 1975, but in the pandemic, as, stimulus checks were going out, the money printer was going, we peaked at, what is this, Matt? I can't even get on.
33.
33 was the personal savings rate. But prior to the pandemic, Matt, though, it wasn't great. It wasn't bad, though. It had actually been increasing for a while. Back in 2019, we're basically at 8.9.
Yep. It
had been trending up since the basically, kind of 2013 post GFC. But since that peak back in 2020, Matt, we've seen some significant declines, and all the way down to a rate of 2.7, which is a rate we haven't seen since really 2005.
Okay, so I'm going to do some pattern recognition here.
Yeah. Oh. Some technical, I know. I believe technical analysis.
Okay, good.
Term for that, Matt.
So we see in this graph. This is for the listeners. It's squiggly line. It follows a general trend, and then there's a few times within this scope.
There's a graph.
Yeah, yeah, exactly. There's a line graph.
There's a chart. There's a line.
Sometimes there's a sharp spike up, and then it sinks down a little lower and then there's kind of like a reverse ripple effect. Right in 1976, it spikes up and then goes down. What I'm looking at specifically, though, is in that 2013, that pattern, it spiked up and then it went a little bit lower and then it kind of came back up again. And so skip forward 10 years or so, and now we are in the way. We are just now crawling out of the descent from the last spike.
The spike in 2012 when it hit 11.16, that's post Geo. That's really kind of post recession, out of the recession.
I would be interested to know.
It drops. There may be something I have right here.
Yes.
February of 2013. Well, we did have a little bit of a drop in the market.
And you can also see in like 2004, 2005, it spikes up and then it goes down and kind of climbs up again. I think now this is my sunny rose-colored glasses thing. I think that things got really bad at the end of last year, and then we're kind of crawling our way out of it. We're still vulnerable in terms of credit.
What do you mean? What do you mean when things got really bad? That
was lower. When the savings rate was the lowest. It was late fall last year, and I think we're trending up.
So we've bottomed.
That's what I think. Yes,
bottomed out. Yep, I'd agree. Now it's low, but it's like. That in itself is not, I think, enough to be like, oh, we're heading over the cliff.
Yeah.
This credit card and other revolving plans, consumer loans, looking at credit cards and other things, while this is not good, the trajectory we're on, I think it kind of it tracks in a sense that's not too outside of kind of like the path that we were on pre-pandemic. It just shows the difference is. The credit card debt went down when we were getting all those payments in the pandemic. And, people have started putting money on their credit cards as that savings has dried up. There's a pretty corollary effect between the two.
Yeah.
And the rate of increase, the slope is definitely steeper. I think what we'd like, it'd be concerning if that continues and doesn't level off, I guess.
Yeah.
And I'm really talking about the rate of change. And just to see the in more detail, it's really not. It's pretty 45 degrees to the right, Matt.
Yeah.
And prior to that, it was not nearly as steep an angle, but not really outside of the line of where it was headed.
And my kind of point too is that the stories that we're hearing about these, the credit and savings situation, they kind of talk about it as though we're in an impending doom. And if we are in doom, it's not necessarily impending. We're just really pretty vulnerable right now.
And that's where it's like that. Whether it's commercial real estate business again in a vacuum may not be the end of the world, but again, if layoffs start happening and all of a sudden people can't keep paying their minimum balances on their credit cards. Not everybody's paying it all off, even though they should be. Then you can start seeing some dominoes roll over, and there's a lot of car auto loans that are having issues. So the consumer's not in a great spot right now. So I think vulnerable, Matt, how you described it, is apt and good. Matt, let's talk about multifamily. We've talked a lot of tangents to multifamily. Let's get into the details. We've got the Yardi Matrix National Report, March 2023. There is a familiar city here, Matt, once again on the cover. I'm getting used to it.
You know what? I wonder if they have Yardi Matrix, because Indianapolis has graced the cover of Yardi Matrix National Multifamily Report for a number of months. I wonder if they have to hire a photographer now, because they're taking so many pictures of Indianapolis.
They need
and you asked why, and I think it might be because we've been leading the year-over-year and month-over-month lists for rent growth.
I think it's because we had Paul Fiorello.
Yeah, that's probably true.
I think we've been able to. We've manipulated the market.
It certainly helps that Indianapolis has done so incredibly well, and also you look at there's a recent CoStar report or Apartments.com report that also notes the strength of the Indianapolis apartment market as well.
Well, just their headline, Matt, multifamily rents advance as economic doubt swirls. That's kind of what we've been talking about all day, all this economic doubts. Let's move on from the economic doubt. We know what that's like. But they're saying demand's remaining firm. The first bullet point, multifamily rents rose slightly in March. The average U.S. asking rent rose $3 in March to $1,706. Year-over-year growth fell to 4% nationally, 90 basis points less than from February, and the lowest level since rents started an unprecedented climb in April of 2021. Next, although financial markets remain volatile due to the collapse of several banks, multifamily property fundamentals are stable. Rents in the national occupancy rate were unchanged during the first quarter of 23, and 21 of the top 30 matrix metros recorded rent gains in March. The third and final point is single-family rental rate increased in March by $5 to $2,079, while the year-over-year increase fell by 80 basis points to 2.8%. Occupancy also decreased 10 basis points in February. Matt, it's still early. I think it's still early, but we are seeing some signs. I mean, just looking at this graph, you can see the dip, you can see the plateau and the slowdowns, and now a little bit of a lip up again. It's like promising, but I think there's a lot of wood to be knocked.
Yeah, and there it's a market by market difference too. Is pretty sharp here, and there's a lot of big markets that are down that may be pushing the national average down a little bit, because you're looking at Indianapolis, Kansas City, and New York actually. All of them around like 7%. That's far from the 4% average.
Yeah, the national average is, there's only a handful of metros that are really above the national averages, Matt. To your point, there's such a big disparity right now between the top and the bottom, with Indianapolis coming out on top. What do they say? 8%, Matt, year-over-year rent growth.
Something like that, yeah.
It's right here. Yeah.
8.6. That's pretty good.
Compared to down at Phoenix, which is really lagging. Looking at losses closer to negative, what is this, Matt? Like 2.5, 3%, something like that. Only Las Vegas and Phoenix are negative, though. I think that's important to note with markets like Austin, which has been, having some headwinds in terms of demand, a lot of new supply coming online. It's positive. 2.8% being the 10-year average.
Yeah, it's just because
over time as a good benchmark. So national average again, for context. But we should be seeing a little bit stronger. This part of the leasing season again. That's where we're waiting to see. When we get through April, really into May, we really should see some stronger numbers. And is it going to be positive at tepid? That's still not. That's fine. It's really not that bad relative to. It's not relative to again, average rent growth, but we have to be reminded we have some headwinds in the multifamily industry on the expense side. So, we're talking about revenue all day. Revenue is great. You can only cut so many expenses. You got to bring the revenue to make it work. But man, there are some costs that are hard to control.
That's what 2023 is for sure.
And if you've got some, if you've got costs that are very hard to control, like such as taxes or insurance, utilities you can control to an extent. Sometimes not all the time, to a degree. Payroll. Again, you can be smart and strategic, but you've got a lot of costs that are increasing. And so, you might be having rents increase by 3%, but if you got your expenses increasing by 5 or 6, it was not good. It's not. Your margins are just getting chopped pretty thin. Then the whole factor, if you're on a floating rate loan and your interest payments, your debt service payments are going up as well. You could have a great performing property. You'd be 100% occupied. You raise rents. Residents love you. Yeah, you've got great reviews. Eden could be hitting all of your NOI targets, but your interest rate has doubled or tripled. You're not cash flowing, or you're close to break even. If everything's going right. Now, what if all your interest rates tripled and things aren't going well? You're not 100% occupied. You haven't raised rents. Your expenses have gone up, but you went from 93, now you're at 85. You haven't been able to raise rents. You're having to give away concessions. People aren't paying rent.
It is.
Your pool's broken.
It's hard to imagine that. Why it's weird that we're not seeing more, because I just know, from hearing the beginnings and ends of some of the conversations that and reading about it, obviously, is this is the time when belts are tightening, expenses are going up. And this Newmark report that I'll reference again, it has a good chart of expected rent growth and expected expense growth. And for most of America, the expenses are expected to grow more than the rents.
Well, Matt, if you're right, let's jump right to it.
Let's
because go check out the rest of the Yardi report. Sign up to the newsletter. Get all those reports and a lot more. GreatCapitalLLC.com/newsletter. But subscribe while you're at it. But anyway, so Matt, MultiFamily Newmark. Interesting report. Give us a break.
So this is they call it their valuation and asset. Basically, it's a North American market survey where they provide a decent overview of a bunch of commercial real estate. And not a whole lot of fluff in the beginning. They jump right into it, and
this is the answer to the what is a good cap rate, whatever that means, for suburban Class A asset on the East Coast. What is a good cap rate? Most people look at you like, I got to get a lot more information from you before I can start to answer that question. But they've got a little bit of some numbers here, Matt. Now tell me, is this a survey or this is actual data?
This is a survey. These rates were compiled and submitted by V&A market leaders based on a survey.
So exactly. So what is a good cap rate? Well, it's all in the eye of the beholder. So there's very little actual real cap rate data. It's almost all surveys, which is opinions of people's knowledge of cap rates. It's not actual transaction data. Very, very rarely that it is. Not that it can't be right.
I will say that not that it can't be right. But sometimes to know the relative value can kind of get you there. Maybe they're not going to nail it absolutely.
Oh, there's tons of value in this. This is from market professionals, brokers, people. I mean, just if it's knowing that this is their opinion. Well, the brokers, these guys think that the cap rates. They might not be, but it's good to know what their opinion of it is. We're not gonna. I can't read down this whole list, Matt, but there's still a lot of cap rates that are starting with a 4. But there's also some There's some that starts with a 6. Matt, tell me what Central is.
Central, I think,
Midwest?
is the Middle West of America.
That's just the middle part.
And I think that it probably is inclusive of some Great Plains. You get some Great Plains in there.
So, and if that's the case, I think that this maybe not too far off. I mean, in fact, I'm going to show this to a couple brokers when we're putting in some offers. I mean, so first West Coast, I'm not going to read them all, but again, range, nothing's in the 5. It's all a range of 4. Multifamily CBD Class A at 4.42, all the way to suburban Class B at 4.9. So they're basically saying mid 4s to a 5 cap on the West Coast. Sure, I get there always had low cap rates out there. Fine, okay. So Central, Midwest, basically CBD, downtown, A class, 5.28. Man, you talk to the multifamily brokers here in the Midwest, they will disagree.
Yeah.
But me personally, yeah, I think that makes sense.
It should be.
Multifamily suburban class B 6.2. I mean, yeah, that's where that's where that makes sense.
Mm-hmm.
Again, I would say this, but like there's very little market data to support this. There's a little bit. There's a little bit, but there's not a ton of price discovery in this area. Like there's a little bit. And I guess it's maybe all we have to go off of.
Yeah. And this could be, like these are the numbers that would make things work.
Some of them, better. Yeah, exactly. I'm like, let's find those deals.
Also in this chart, so they have.
I don't know, maybe I need a 7 cap.
Yeah. To the right of those cap rates, and you're gonna have to answer. You're gonna have to answer a couple questions because
I'm sorry, I didn't see the scroll.
I was doing some No, that's fine. There's enough. Come for the cap rates and go for and stay for these other these other values. They also have the discount rate, which I'm gonna need again. Like I want to figure out how it's used in this context because I know the definition of it, the textbook, but I'd like to know how it's being used here. And then they have the rent. Importantly, the rent growth rate and the expense growth rate. Everywhere except for. What is it? The South and the Central. So Central is rents are even with expenses. Mm-hmm. South rents are a little bit above expenses, but for United States average, expense growth is greater than rent growth. How do you get around that?
Exactly, and that's what I've been saying, Matt. That when you have revenue that's decreasing and expenses that are rising, so you got NOI declining.
Yeah.
You've got cap rates increasing. And the cap rate formula is, NOI divided by your cap rate equals your value. Mm-hmm. So again, NOI, the numerator. I don't know much about math, but I know this one. Mm-hmm. NOI is going down divided by cap rate going up. Mm-hmm. It's not good. It's a smaller number.
Yeah.
When you press equals.
Yeah, that's a good point. Yeah.
It's just pretty straight math, and it's like not a linear like one for one. It's like it's a lot worse on your valuation. So that's what that means, and that's what the concern is. Matt, to be honest, I'm not sure how they're using discount rate here. In this context,
I had some discussions.
Other than this is the interest rate that you're going to need to buy the asset.
Okay.
And so they're basically saying that you're basically have a negative spread. You're borrowing at 6.5, but you're going to be buying at 4.2. It is the way that I'm seeing.
And see, I was wondering too because there's also a definition of discount rate as the net present value of future earnings, But my real point is this graph, it showcases a situation in the multifamily market where, first of all, there's not a whole lot of buyers. We already know that. But the expenses are rising faster than the rents. And that's going to be difficult to get around. And it's going to make it, like Mark Zuckerberg has said, an era of efficiency. And as you just illustrated earlier, it's a complicated, there are so many levers, so many details to manage and keep expenses down. And it's a full-time job, and my hats are off to all these asset managers and property managers in making these decisions and staying on top of everything to make sure the costs come down, because that's going to be the challenge in 2023.
Yeah, no, exactly. I mean, that's why we've been focused on operations, getting expenses in control, centralization, being efficient, how can you use technology. And honestly, necessity is mother of all invention, right? So we have, you can be inefficient until you can get away with being inefficient until all of a sudden, it's pointed out. It's not going to work. And so it's an opportunity for the industry to become more efficient, but it's not, again, if you've got, if you did a skinny deal, which a lot of people are doing skinny deals. I know a lot of skinny deals, not our deals, but I know a lot of skinny deals out there. They're going to require some capital and some backbone, and there's some good operators out there that can did a skinny deal, but they're going to be able to figure it out. There's going to be some bad operators that aren't going to be able to figure it out. So let's all buckle up. Get ready for a good ride. All right, Matt. Anything else? Before we wrap up, anything else we should touch on? That was a great report. Where can I go?
So I would go. I'm going to put this in the notes, but if you want to sign up for the newsletter, all of these articles were in the newsletter. One article that we didn't get.
Is it a good news? Like,
oh, it is
good.
Probably the best
good.
multifamily newsletter that's out there. Maybe in the world, I think. At least in the nation.
No, that's what it was rated as.
All right.
Well, according to rating agency.
Yeah.
Thank you for taking your time watching or listening to this edition of the Gray Report. Catch us next week and every week talking about the multifamily industry, the economy. It's going to be different next week, Matt. We'll be here to tell the story.
Oh, yeah.
Okay. Thank you.